Hi, I'm Gabriella Vanilla from Blythe Waste, Johannesburg, and I'm here with Mark Learmonth, CFO of Caledonia, and Steve Curtis, CEO of Caledonia, to discuss Caledonia's results for the 6 months to the end of June 2015, which were released this morning. Hi Mark, hi Steve. Mark, before we go into details of the results, can you give us a broad overview of the outcome of the half year?
Well, Gabriella, it's the quarter and the half year were pretty much as we'd expected. The production was exactly on target, perhaps even slightly ahead. The gold price in the first half, so the gold price might have fallen at the end of the quarter, but the first half the gold price was again pretty much what we expected. Costs, online costs, with the slight exception of electricity, again was very, very close to where we'd expected it to be. At the group level, G&A costs were slightly higher than we'd expected, and that really is because it took us longer to extract ourselves from Zambia than we'd expected, and it cost us more to get out of Zambia than we'd expected. But if we adjust for those Zambian costs, which are now finished, we won't have any more recurring costs coming out of Zambia. The group G&A has started to come down slightly, and that's balanced by us increasing the capacity at the head office here in Johannesburg. So we're cutting costs. We've reduced our cost base here in Johannesburg, but we're increasing the capacity, which is important as we build out the mine and the revised investment plan in Zimbabwe. And the other thing that's happening as we expected, perhaps a little bit slow, but it will reverse in the second half of the year, is the tax charge has come down, particularly the income tax charge. So in the first half of the year there was a small income tax charge. We expect that will reverse in the second half, and so the income tax will actually be shown as deferred tax, and that just reflects the rate at which we're spending money in Zimbabwe, which shields the taxable profit in Zimbabwe from Zimbabwe income tax. So yeah, very much as we expected. These are really the sort of the quarters where we're sort of marking time, so to speak, as we get down and sort of deliver on implementing the revised investment plan.
You already reported production for Q2 and the first half of 2015 several weeks ago, so we already know how many ounces of gold you were selling. But can you talk about the gold price you realized in the quarter?
Yeah, the gold price we realized in quarter two was pretty much as we expected. We'd been budgeting on a gold price of $1,200, and we achieved $1,174 an ounce. That's after the small early settlement discount that we pay to Fidelity in Zimbabwe. That compares to pretty much exactly $1,200 an ounce we achieved in the first quarter. Again, lower than we achieved in the whole of 2014. In the whole of 2014, we achieved $1,245 an ounce. So clearly, we are in an environment where the gold price has fallen, and it's fallen very quite sharply since the end of the quarter. And one of the things that we're doing is we've already taken the steps to reduce our head office cost base. And that will be reflected in numerical terms in quarter three and quarter four. So we've already done that. And the best thing we can do now is from a strategic perspective, is to press ahead with the implementation of the revised investment plan, so that from early 2016 onwards, we can start to see increasing production, increasing sales, and that flows through into a benefit from reducing costs as well. So we're now, as we speak today, we're in early August. We're only 4 or 5 months away now from starting to see the incremental production as the work we're doing on the revised investment plan starts to come to fruition.
Production cost for the quarter was similar to the cost in the previous quarter, but are still higher than, let's say, a year ago or so. Can you explain why your costs are now higher? Yeah,
in quarter two of 2015, in Canadian dollar terms, our production costs were about $9.24 million, which is nearly 20% higher than the production costs in the comparable quarter, so quarter two of 2014. But if you adjust for the Canadian exchange rate, so in quarter two of 2015, the Canadian exchange rate was $1.23 to the US dollar, In quarter two of 2014, it was only $1.09 to the US dollar. If you adjust for that, the increase was actually only 6%. So in dollar terms, it went from $7.11 million to $7.52 million. So there was an increase in US dollar terms. If you look at it in terms of the cost per ton that we milled and mined, the increase was actually only 1%. So our cost per ton went from 72 US dollars a ton to 73 US dollars a ton. So that's not really a significant increase in costs, and actually that cost is probably reflected in slightly higher usage of electricity towards the end of quarter two 2015, and also we've slightly changed our mining methodology in some areas, so that we now adopt a mining methodology which allows us to control grade better, because as you realise, one of the issues that's affected production is the lower grade, and in a lower grade environment we've got to make sure that we do manage that grade much more closely. And so that means the mining methodology that we've adopted this year in 2015 is slightly less efficient. So it results in higher costs, but it does mean that you manage your grade more effectively. So that explains why the cost per tonne has gone up very slightly. In terms of costs per ounce, the on-mine cost has increased from $611 an ounce in quarter two of 2014 to $729 an ounce in quarter two of 2015. That's nearly a 20% increase. And at the higher level, the all-in sustaining cost has gone from $878 an ounce to just over $1,000 an ounce, which is a 17% increase. And the disparity between the relatively modest increase in the cost per tonne, but the higher increase in the cost per ounce, that reflects the lower grade. So simply we're moving more ounces to get the same amount of gold out of it. So that's why the cost per ounce has gone up. As we increase production in terms of the revised investment plan, we expect two things to happen. First of all, we expect the grade to improve slightly. So currently we're operating at about 3.25 grams a tonne. As we implement the revised investment plan over the next few years, the grade will recover to about 4 grams a tonne, which is slightly higher than we were previously, and that automatically unwinds then the disparity between the cost per tonne and the cost per ounce. But the second thing that we expect to happen is, as we increase our production, it means that the fixed cost base at Blanket gets spread over more ounces, which also helps to bring the cost down. So where the costs are right now is pretty much exactly where we expected them to be. We did expect the cost per ounce to increase as we were in a lower production environment and with a lower grade. And we have seen as we move forward and we increase production, we do expect the cost per ounce to reduce. So very much where we expected it to be. Looking at the wages, you can see that the rate per man hour paid increased by about 6%, which reflects the increase that we gave to the workforce in Zimbabwe this year. And you also notice that some of the consumable costs have been coming down. So the consumable cost per tonne milled has come down from about $24.50 in quarter two of 2014 to about $23.60 in the quarter just finished. And that reflects slightly more efficient usage in some consumable types, and also falling costs. Some of the input costs have actually been falling. Where our production costs have surprised us slightly is the electricity cost. So you'll see that the electricity cost per tonne milled has increased from about $16.90 in quarter two of 2014 to about $19 in quarter two of 2015. To some extent, that does reflect increased consumption. So in particular, the new Centac compressor that we installed and is now operational does use more electricity. That accounts for some of the increase in the electricity cost. But in the case of the Centac, those increased costs are actually more than outweighed by the increased operating efficiency, so from a labour and personnel perspective. It's an area that management are looking at right now as to what we can do to try and reduce that electricity consumption. But in the overall context, our electricity consumption isn't massive, and that's not a major problem for us.
So can we expect to see cost reduce in the future?
Absolutely. As we increase the ounces, as the grade goes up, we do expect production costs to fall from early 2016 onwards. And actually by mid-2018, we're looking at an all-in sustaining cost of below $750 an ounce, and an on-mine cost of the mid-500s. So yes, we do see significant scope for these costs to come down as we implement the revised investment plan, which is one of the main reasons why we're pressing ahead with the implementation.
While we're talking about operating costs, can we focus on electricity? The mining sector in South Africa is currently being badly affected by a shortage of electricity. What is the electricity situation in Zimbabwe?
Well, it's fine. You mustn't read across from the situation here in South Africa to assume that also applies in Zimbabwe. We get pretty much uninterrupted power supply from the Zimbabwean authorities. The gen sets have run sort of 30 hours or so this year to date, and so we're not having interruptions to power as would happen here in South Africa. So that's just not an issue for us.
Administrative expenses have come down slightly, but there has been an increase in wages and salaries. Why is that?
Well, Gabriele, you're right. In US dollar terms, after adjusting for the costs of the Zambian operation, which we've now closed completely, we have seen a modest reduction in the G&A costs. So in the first half of 2014, it was about $2.96 million US dollars. In the first half of 2015, it was about $2.86 million US dollars. The Zambian operation was quite expensive, and particularly in quarter two of 2015, as well as the ordinary run rate of salaries and wages in Zambia, we actually also incurred about $500,000 of closure costs, which we paid in May. The Zambian office was closed at the end of May, and we expect to see no further expenditure at all coming out of Zambia in quarter three, quarter four, 2015, and thereafter. So I think it is appropriate to deduct those Zambian costs when we're looking at group G&A. You mentioned, wages and salaries have gone up. In the first half of 2014, there were about 885,000 Canadian dollars, and that's increased in the first half of 2015 to about 1.5 million Canadian dollars. And that reflects a couple of things. It reflects an increase in the headcount here in Johannesburg. So we've increased our headcount from 10 people to 13 people, particularly in the area of technical services, where we're now doing much more to assist the blanket management team on implementing the revised investment plan. And it's important that we do that because we need those skills and that capacity to make sure that that plan is implemented appropriately.
The taxation charge has reduced from earlier quarters. Why is that, and do you expect the lower taxation rate to be sustained?
Yeah, we did expect the tax charge to reduce. I mean, as we're spending a lot of money in Zimbabwe at the moment, and so just the way the tax is calculated, it means that capital expenditure is offset against the taxable profit in Zimbabwe. So it means effectively you shouldn't be paying as much tax this year as you would in the previous years. The rate of capital expenditure was relatively slow. It got off to a slowish start in 2015, so we didn't spend as much in the first 6 months of 2015 as we expected to. That is reversing rapidly. The second half of 2015 we are going to spend an awful lot of money. So what I expect to happen over the course of 2015 is that the tax charge that we're showing in Zimbabwe will actually reverse, and we'll actually see a higher deferred tax charge, which is non-tax, which is non-cash, and a smaller income tax charge. So it's worth noting that even though the overall income tax charge has reduced from an effective rate of about 50% to 41%, we've actually not paid any income tax in Zimbabwe this year, because over the course of the year we actually expect to be in a zero tax position on a cash basis in Zimbabwe. And we'd expect that to continue through into 2016 and 2017 as we continue to spend a lot of money. You also see that the withholding tax charge has fallen significantly. So we're now only incurring withholding tax on the management fee that we pay out of Zimbabwe to South Africa, because temporarily there's no dividends flowing out of Zim up to the UK. We're not incurring any withholding tax on that. So yes, the tax charge is lower, and we expect it to reduce even further over the course of the next year or so.
Turning to the balance sheet, the most significant feature seems to be that Caledonia retains a strong cash position. This against the background of a lower gold price, and you're in the middle of a very significant capital expenditure program. Is this what you expected?
The balance sheet is probably slightly stronger than we'd expected. As I've already mentioned, the rate of spending in Zimbabwe in the first 6 months of the year was a little bit slower than we'd expected. That is reversing, and we're now spending large amounts of money on a monthly basis to implement the plan. So yeah, the balance sheet is slightly stronger than we'd thought. $23 million of cash is about $8 million better than we'd expected to be. So we've got the $23 million of cash at the end of June. We've also got $5 million of undrawn Zimbabwe overdraft facilities. So we've got available to us right now nearly $28 million, $29 million of funding capacity. We do expect our cash position to reduce as we continue to invest heavily. The cash position is also not helped particularly by the lower gold price, but certainly at a gold price of where we are at the moment, we have the cash resources to continue the investment plan. And as I've mentioned, it's only by pushing ahead with the implementation of the revised investment plan that we can achieve the higher production and the lower costs that will actually position Blanket and Caledonia to withstand a much lower gold price environment.
So is the capital investment program on track?
Absolutely. We're up at the mine a couple of weeks ago, and the whole Caledonia board visited the mine a couple of weeks ago. As we announced, we finished the tramming loop on time. We've also finished the sinking of the number 6 winds on time. That shaft is now being equipped, and we'll start horizontal development into the ore body in the latter half of the year. So that's very much going as planned. And in terms of the central shaft, the activities that are taking place there again are exactly as we expected it would be. We've excavated the area for the collar. We're now busy filling that with concrete. We've excavated the area for the foundations, for the winders and all that sort of stuff, so that's happening. One thing that is perhaps happening slightly quicker than we'd expected is we are now beginning to advance or bring forwards some of the purchases of key bits of equipment as they become available in South Africa at attractive prices. We feel that if the right bit of kit's available and the price is right, even though we don't need it perhaps for another year or 18 months or so, we ought to be buying it to make sure that we've got it so we can use it when we need it. So all going very much according to plan, which is good.
And finally, perhaps we could discuss the effect of the lower gold price on Caledonia, and particularly on the ability to implement the investment plan and the implications for Caledonia's dividend.
Well, yeah, that's the key question that investors and shareholders are asking in this lower gold price environment. As we all know, the gold price fell sharply in July after the end of this reporting period. Caledonia retains significant cash resources. It's got $23 million in cash on its balance sheet. Blanket has increased its local borrowing capacity from $2.5 million to $5 million. So we have plenty of cash, which means that, if the gold price fell further, we're in a position to provide financial support to Blanket to make sure that it can implement the revised plan. So for the time being, we're watching the gold price very carefully. We've taken measures already to reduce the head office cost base, and that will be reflected in lower G&A in quarter 3 and quarter 4. So it means we're not burning cash at the top company level as quickly as we were in previous years. And we're now in August. All we've got to do is when we start getting into January next year, we should start to see the benefits of rising production. So absolutely, we are committed to implementing this revised plan. We think it's the best thing to do to get production up, get the benefits of reduced economies of scale in terms of the reduced operating costs. And we watch if the gold price fell further. Clearly, we'd have to take steps to perhaps rejig the capital investment program, perhaps cut costs further. But certainly as we stand at the moment, we think we've taken the preemptive action that was necessary to put us in the position so that we can actually continue to implement the revised plan in the context of the current lower gold price.
Thanks, Mark. Turning to Steve. Steve, what do you believe is the outlook for Caledonia in this increasingly challenging environment?
Well, Gabriella, it's a different environment since we last spoke, but the focus inside of the company is still exactly the same. We are completely committed to the investment plan. That is ongoing, it is on track, and we will continue to make progress on that project. We will also continue to spend money and effort on exploration projects. That is part of the development of the mine and the extension of the life of this mine. Obviously, all of this takes money, and with a lower gold price, we have to be cognizant of the effect of this lower gold price. But as Marcus said, Caledonia does have roughly $23 million in its treasury, and we will support Blanket as and when necessary to ensure that there is no interruption to the project of any nature. We are also very cognizant of the importance of the dividend to Caledonia shareholders, and we will do what is necessary to protect that, considering the circumstances we find ourselves with the gold price. We've obviously also taken the steps necessary to reduce G&A costs, as Mark spoke about. And so we think that the business is now right-sized. We've taken costs out where we can. We've brought in skills that we need for this project. So I think, although it's a tougher environment, we are well placed to proceed into the future.
Thanks, Mark and Steve. We look forward to further updates.
Thanks, Gabriella.
Thank you.